Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week, we're discussing how to determine the basis of inherited property that's held in joint tenancy. Spidell's federal and California tax update is the best 8-hour update to prepare for the upcoming tax season. Learn about election year tax bills and proposals, the new beneficial ownership reporting requirements, using AI in your tax practice, and more. Get registered for a live seminar or webinar session at caltax.com. There are numerous ways to hold title to assets, and the way title is held can affect how much of the property is included in the decedent's estate, the basis at which the beneficiary inherits the property, whether the property can be willed to a person other than the joint owner, and whether the asset will be included in the decedent's gross estate subject to probate. We frequently receive questions concerning how to determine the basis of inherited property when the property is held in joint tenancy. There is one set of tax rules for spousal joint tenancies and a different set for joint tenancies that include non-spouses. The conflict between these two sets of rules often causes confusion when it comes to a surviving joint tenant's basis in inherited property. For estate tax purposes, 1/2 of the fair market value of joint tenancy property held by two spouses is included in the gross estate of the first spouse to die. This is true regardless of how much each spouse contributed toward the purchase price of the property. Calculate the basis for a surviving spouse by adding 1/2 of the property's cost basis to the value included in the gross estate. Subtract from this sum any deductions for wear and tear, such as depreciation or depletion, that are allowed on that property to the surviving spouse. Note that this treatment is different than if the property was community property. For community property, the surviving spouse would receive a full step-up in basis for the entire property upon the decedent's passing, including the surviving spouse's share. There has been much discussion and several court cases addressing whether California community property laws supersede the fact that a couple elects to hold title as joint tenants. While some taxpayers have been successful with this argument, the IRS has not acquiesced to it, and it will likely require a court decision. In some cases, it has been sufficient to include a statement in the couple's will or a written agreement that all property is to be treated as community property. However, with newer methods of holding title, like community property with right of survivorship, joint tenancy probably should not be used between spouses in California. Regarding unmarried joint tenants, the entire value of a joint tenancy asset held by non-spouse joint tenants is presumed to be included in the estate of the first joint tenant to die. The asset may be excluded from the estate, however, if the surviving joint tenant can prove their contribution to the acquisition of the asset. The surviving joint tenant then gets a step-up in basis equal to the amount that was included in the decedent's estate. Calculate the surviving tenant's new basis in the property by adding their original basis to the value of the property that was included in the decedent's estate. Subtract from this sum any deductions for wear and tear, such as depreciation or depletion, that are allowed on that property to the surviving joint tenant. It's important to keep in mind that the estate tax rules are different from the income tax rules. For income tax purposes, the property is held 50% by each joint tenant, so they're each required to report 50% of the income from the property on their individual tax returns, regardless of the amount of their actual contributions. Also, if the property is sold, each joint tenant will report 50% of the gain from the sale. Although the cost of the property for estate tax purposes is considered to be based on the contribution by each joint tenant, the accumulated depreciation for the surviving tenant is 50% of the total. We covered this topic in an article in a past issue of Spidell's California Tax Letter, including information on gifted property, several illustrative examples, and a chart comparing methods of holding title. For subscription information, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.